You were told stability was success. Get a job, earn a salary, be secure. And for most people, that sounds responsible. Predictable income, structured weeks, defined roles. Every 2 weeks, money arrives. Reliable, controlled, safe. But here's the uncomfortable question. If salary income is so stable, why do so many people feel financially stuck? Not broke, not reckless, just stuck. The answer is not effort. It's structure. And today we're going to break down the salary trap, not emotionally, structurally. Because once you understand the structure, you stop blaming yourself. When you accept a salary, you enter an agreement. You trade time for money. 8 hours a day, 5 days a week. For years. On the surface, that seems fair. You give effort. You receive compensation. But hidden inside that agreement is a limitation. Your income depends on your presence. If you stop working, income stops. There is no multiplier attached to your time. Just repetition. Time is finite. And anything tied directly to time inherits its limits. You cannot work 24 hours a day. You cannot duplicate yourself. You cannot scale your hours infinitely. So income tied to time can never multiply beyond it. That is the first constraint. Now compare that to ownership. Ownership does not depend on presence in the same way. Assets can produce income, even when you are not actively working. Rental properties generate rent. Equity grows in value. Businesses operate through systems. Digital products sell without manual effort every hour. That is leverage. Leverage allows output beyond direct labor. And leverage is what creates scale. Salary is linear. Ownership is exponential. And exponential structures outpace linear ones over time. Not because workers are less intelligent, but because math is neutral. Let's slow this down with an example. Imagine 2 people. Both earn the same salary. Both are disciplined. Both save 10% of their income. The first person keeps savings in cash. The second person uses savings to acquire productive assets. Over time, inflation reduces the purchasing power of the first person's savings. But the second person's assets grow. They appreciate. They generate returns. They compound. 10 years later, both worked equally hard, but their positions inside the system are different. The difference is not effort. It's structure. There's another layer most people overlook. Taxation. Salary income is taxed first. Before investing. Before building. Before compounding. It is visible income. And visible income is the easiest income to tax. But asset-based income is often treated differently. Capital gains, appreciation, structured distributions. This is not about morality. It's about how the system categorizes income. Salary sits at the most exposed point of the structure. Ownership sits further inside it. And positioning determines outcome. Now let's run a simple projection. Imagine you earn $50,000 a year. You receive a 3% raise annually. That sounds reasonable. After 10 years, your salary increases gradually, but your income is still tied to your presence. Now imagine you take just 10% of that income and consistently allocate it into productive assets, earning an average return of 7% annually. At first, the difference seems small, but compounding does not move dramatically in year 1. It accelerates later. By year 10, the asset portfolio begins generating returns on its own returns. By year 15, growth begins to outpace your raises. By year 20, the compounding curve bends upward while salary growth remains linear. This is not theory. It is mathematics. Linear growth adds. Exponential growth multiplies. And multiplication always overtakes addition over time. The difference between the two is not visible in the beginning. That is why most people underestimate it. Now let's talk about ceilings. Salary has a ceiling. Raises are incremental. Promotions are limited. Even high earners operate within defined bands. You can work harder. You can gain credentials. You can increase efficiency. But your earning structure remains linear. Meanwhile, assets compound. If a business grows by 10% this year and 10% next year, that growth builds on itself. That is the multiplier salary lacks. Without a multiplier, effort alone slows down over time. Here's where it becomes psychological. Salary feels safe. You know what's coming next month. You can predict your budget. You can forecast your bills. That predictability creates comfort. And comfort reduces urgency. But dependence on a single employer concentrates risk. If the company restructures, income disappears. If the market shifts, income disappears. Security inside a system is not the same as independence from it, and that distinction matters. There is also an emotional dimension. When your identity is tied to your job title, your security feels attached to approval. Performance reviews matter. Promotions feel like validation. Layoffs feel personal. But ownership shifts identity. When assets generate income, your worth is no longer measured solely by employment status. The psychological pressure reduces. You begin making decisions based on positioning rather than permission. That shift is subtle, but powerful. From childhood, the script is clear. Study hard. Get credentials. Secure employment. No one explains capital allocation in school. No one teaches leverage early. No one breaks down asset positioning. The system trains participation, not ownership. It prepares workers. It does not automatically prepare investors. That is not a conspiracy. It is structural design. Now pause here. This does not mean salary is wrong. Salary can be powerful. Salary can build initial capital. Salary can create discipline. Salary can fund opportunity. The trap is not earning income. The trap is stopping there. If salary becomes the final destination, instead of the starting point, growth slows. The shift happens when income begins purchasing leverage, when savings become assets, when time begins funding ownership. That is where structure changes. Let's bring this back to feeling stuck. Most people increase effort when they feel stuck. Work more hours. Take on extra responsibility. Pursue promotion. But if the structure remains linear, effort alone will not create escape velocity. You cannot outwork a structure designed without a multiplier. The solution is not burnout. It is repositioning. Repositioning does not require immediate entrepreneurship. It requires awareness. It requires asking different questions. Instead of, how can I earn more? Ask, how can I own more? Instead of, how can I work harder? Ask, how can I introduce leverage? Because leverage changes trajectory. Here is the truth most people never hear. The system rewards scale. Scale requires assets. Assets require ownership. And ownership begins with capital allocation. Salary is one way to generate capital. But ownership is how capital multiplies. And once you see that difference, you cannot unsee it. Now imagine two futures. In the first future, you continue trading time for money for 30 years. Raises come slowly. Expenses rise steadily. Retirement depends on disciplined saving alone. In the second future, you still work. But every year, ownership increases. Assets slowly begin producing independent income. Eventually, income is no longer dependent on your hours. In both futures, effort exists. But in only one does leverage exist. And leverage is what bends the trajectory. If you only trade time, you remain inside the structure. If you build ownership, you begin interacting with it differently. That shift is the difference between effort and leverage, between linear and exponential, between stuck and scalable. And understanding that structure changes everything. Subscribe if you want to understand how the system really works.